Hello, everybody. My name is Lee Schwartz, and I'd like to welcome you to our webinar for veterinary practices. Today's topic is Year-End Tax Planning 2021, what's new and what you need to plan for. So I noticed a lot of familiar names on the attendee list. I know a lot of you have been a part of our past webinars, and we're excited to continue bringing you this important information. So we will jump in here in just a sec, but a couple of quick housekeeping items. If you have a question during the webinar, open up the chat box in Zoom and submit your question to all panelists. We have a lot of content to cover here, but we are going to try to leave a couple minutes at the end for Q&A. Also, we're recording this webinar today. You will receive an email with a link to a survey, as well as our SVA resource page where the webinar recording will be available. Now, many of you are already clients of SVA, and we'd encourage you to reach out to either your SVA contact, or any of our presenters if you have questions coming out of this. I'd also encourage you to share our contact details with other business contacts who you think could use our help. Over the last year and a half, we've found that there are just a ton of vet practices that aren't getting timely or knowledgeable advice from their CPAs or their advisors, and obviously we'd be happy to step in. Now, if you're not a client and you have questions, please reach out to me, and I'd be happy to get those questions answered or get you connected to a subject matter expert who can help. So with 2021 coming to a close, it is the perfect time to review your practice's tax planning strategy and look ahead to 2022. Our presenters today will go over the latest legislation that may affect you. They'll go over business and personal tax planning strategy scenarios and talk about some next steps. So if you've attended any of our past webinars, you're already familiar with Andy Slinger, who's a principal with SVA, but this may be the first time you're seeing Joel Rechlicz, who's a manager in our healthcare and vet practice. Both Andy and Joel help lead the team that works with veterinarians around Wisconsin and really the whole Midwest to help them minimize taxes and maximize profitability. So I'll be back towards the end, but Andy, I'm going to let you take it from here.
Awesome. Thank you, Lee. And thank you again, everyone, for joining us. We're very excited for what's now the third installment of our webinar series this fall. And if you're anywhere in our area, what feels like early winter, But to kick it off, we thought we would just get the pulse of the room here, see where you all stand, and start with a poll question. Very simply put, have you already discussed proactive tax planning with your advisor for 2021? Yes, no, or got it scheduled? Drum roll. Okay. Well, it's a good mix. So some of you, you're ahead of the curve. You already had some conversations. Some of you haven't. None of you have it scheduled. So I think one of the takeaways today is, even if you already had it done, continue the conversation. And if you haven't had it, see if you can get something scheduled before the end of the year that's approaching very quickly. So what do we hope to accomplish today? As Lee kind of introduced, give you the latest tax legislation being discussed in Washington, D.C. One of my stressors for today, this changes almost daily. Okay, if we would have had this webinar a week ago, this part of the presentation would be completely different because everything changed last Thursday. As I'll talk about after a couple elections last night, there may be even more changes now. Okay, so it's very timely. A week from now, it could be completely different. So make sure if you're reading articles, if you're watching recorded videos, look to see when those were published because everything's changing quickly. Very briefly, we'll look at the PPP loan forgiveness. A year ago, we were knee deep and neck deep in PPP everything. Now the dust has settled. Just want to revisit a few things that make sure didn't get lost in the shuffle. And then maybe for the first time, introduce the employee retention tax credit, which really doesn't apply to, I'd say, the overwhelming majority of vets, but just in case, I want to give you a very high level presentation of it. I'll hand it off to Joel. He'll go through some tried and true business tax planning opportunities along with individual tax planning. And then since we're presenting so much information today, I want to kind of wrap it up and just kind of narrow down some things that I think will apply to the widest audience. Okay. All right. Before I get started, the other thing I want to stress, and it's sort of a disclaimer, but it's really a stressor. A lot of you are clients, some of you are not, okay? If you're not, we don't know anything about your situation. So please make sure that if you're not one of our clients, that you take the information presented and either take it to the advisor that you do have, or if you either have an advisor, don't have an advisor, but realize, you know what, it may be time for a new advisor, we would love the opportunity to talk to you. But bottom line is, take the information and make sure you talk about it with a tax professional that knows your individual situation. Okay, so the DC update, that I'll call it. Little history lesson. If you rewind 12 months ago, I did a similar presentation, and it was after the presidential election, but it was before the runoff elections in Georgia in the Senate. And I said that my crystal ball said that with a 50-50 Senate, with a very small majority in the House, that my prediction was there would be minor tax legislation changes, if any, coming. Okay. Well, 12 months later, there's been nothing. There's been, of course, things that have occurred related to COVID and stimulus and things like that. But as far as tax legislation, there have been absolutely no changes up to this point. A lot of talk, no changes yet. So there were a lot of proposals up until last Thursday. As of last Thursday, October 28th, all of the proposals that were on the table were again drastically reduced, because what they're trying to do is they're trying to put together a bill that will get through Congress. And up to this point, they haven't been able to do that. So they keep talking. All right. And then last night, there were two elections that weren't supposed to be such a big deal nationwide. One was a gubernatorial election in Virginia, and the one that didn't even make the PowerPoint was the gubernatorial election in New Jersey, which is still too close to call. And according to the political experts, it wasn't supposed to be close. So the point in that is that, again, those two elections may have some nationwide implications in that it forces more discussion in what legislation might be passed, especially as we get closer to now the 2022 midterm elections, okay? As you get closer, there's typically less activity. So we'll see. My point on all this is stay tuned. It's changing. The proposals are much less. Nothing has passed so far. And what ultimately matters is what becomes law, because up until then, it's just talk, okay? So it's a fluid situation. Stay tuned. Even if there are changes, does it even apply to you? Okay. A lot of the things that are still in the bill, proposed bill, apply to what I'll call the ultra rich. I mean, if you have tens of millions of dollars and you're joining us, some of it might apply to you. If you have an ultra big corporation on the side, tens of millions of dollars might apply to you. My point is, a lot of that doesn't. So make sure that it applies to you. And, just focus on that, because there's so much going on right now. So that's really the DC update. Nothing's happened. Quite frankly, I anticipate that anything that is passed is relatively minor and may not apply to you. So what are the specifics? Again, this is the October 28th, 2021 version of what's called the Build Back Better plan. And again, I put the date on there because that matters. Could be different on November 10th. I think the one that might apply to some of you is right now, there's net investment income tax, okay? And it's the 3.8% tax. And up until this point, it doesn't apply to your active business income. If you're an S Corp, for example, you may pay yourself a salary, but then the remaining income is probably reported to you on a K-1, and that's called S income. And that income, as you distribute it out to yourself, is not subject to payroll taxes, okay? So there's a proposed expansion of that now would tax that income if, as a single filer, your modified adjusted gross income is at or above $400,000. If you're married filing joint filer, $500,000 is that threshold. So again, this comes into play as I'll talk about. Veterinarians are making more and more money, Okay, so you might reach those thresholds. That's probably the one to watch right now in the current version. Really, what came out on October 28th, more of the focus was what was no longer in the bill, proposed bill. And what's no longer there as of October 28th is no change to the top individual tax rate, no change to the capital gains tax rate. There was talk of people selling off a lot of their appreciated stock to try to capture it at a lower tax rate. Not on the table right now. There was talk of eliminating the quote unquote backdoor Roth, which Joel will talk about, not on the table. And then there was also talk about modifying the qualified business income deduction, or what we call QBI. Again, not on the table. So again, there's less there than there was before. And again, if I were making predictions, it will stay that way or be even less going forward. So stay tuned. As always, we'll be on top of it if and when there are new proposals, or if and when there are bills that are actually passed into law. All right, let's go into the PPP loan. So just a reminder, okay, because like I said, a year ago, it was more of a whirlwind. As far as the PPP loan and veterinarians, okay, most of you, I would say, applied for the first round and got it, okay? Few, if any of you, qualified or received the second PPP loan, okay? So really, regardless, if you got a PPP loan, just a reminder that income, that cash that you got, is not taxable. My biggest fear is there'll be somebody out there that reports that on a tax return, on a financial statement, and it'll be taxed. I don't want that to be you. So just a reminder, that is not taxable. The other benefit is that cash that you got, the expenses that you pay, those are tax deductible. So it's the best of both worlds. You got the money, it's not taxable, but the expenses you pay are deductible. Okay, so best of both worlds. And by now, if you got the first loan, you should have had it forgiven unless something got hung up. And hopefully it was a pretty straightforward application process where you were able to get that loan forgiven by just using payroll costs. You probably didn't have to go into the complicated formulas of rent and interest, etc. So that's where you stand. Now, if you have excess cash, what do you do with it from a tax planning perspective? Right now, if I look at your balance sheet, like many veterinarians, you're probably as flush with cash as maybe you've ever been, okay? Recommendations we've been making is if you have high interest debt, might be the opportunity to pay that down. A lot of veterinarians are investing in their practice, either in their people, in equipment, in those repairs you've been putting off, in that build out, that expansion that you need with the increased volume that you're seeing. You just don't have the capacity. Some are just saying, you know what, there's still a lot of volatility out there. I want to retain some cash for that rainy day. Okay. And then lastly, which is the reason for this slide, is if you've done all that and you're ready to take some of that money out, make sure that it's taken out of the business in the most tax efficient manner possible. And it really depends on your entity type, and you're all either a sole proprietorship, or you have a partnership, or you're an S corp, or you might still be a C corp, and the strategy is different for all of them. So I can't go into all the examples, but again, just make sure you talk to us or talk to your professional. You're looking to take cash out. What's the most tax efficient way to do it? All right. The Employee Retention Tax Credit, the ERTC, we love acronyms, does not apply to most veterinarians. Okay, here's why. In 2020, in one of the quarters in 2020, you would have had a 50% or greater reduction in your revenue, 50% or greater. Did not apply to the vet world for the overwhelming majority of you. I'll talk about some potential exceptions, but probably none of you experienced a 50% reduction in a quarter in 2020. For 2021, it's a 20% reduction in a quarter. Okay, again, I'm seeing most veterinarians maybe are at almost 20% increase in 2021. Okay, so likely doesn't apply, but let me just, potential exceptions. Maybe you lost an associate or two. They're very hard to find. They're very hard to recruit, retain. Maybe you lost them. You weren't able to replace them. You had to temporarily consolidate your business or not do large or not do small or vice versa. Maybe it applies to you. Maybe there was a medical leave of some kind, another special circumstance. Again, if you had a significant reduction in revenue in a quarter in 2020 or 2021, at least mention it to us, mention it to your advisor to see if by chance you qualify. If by chance you do qualify, you have to consider that application in conjunction with how you applied for your PPP loan forgiveness. Thing to remember, you can't use the same payroll costs to get the PPP loan forgiven as to get a credit on the employee retention tax credit. Okay, that would be double dipping. So just remember, you have to coordinate the payroll costs and how you apply for each. Something to consider. Okay. Want to get into business and individual tax planning. So I'm going to go ahead and turn it over to Joel, and he'll kick things off with another poll question.
Hey, everybody. All right, so the second poll question is, for the tax year 2021, do you think you will pay more in taxes, less in taxes, or about the same? Give everybody a few seconds here to answer. And pretty much what I thought, 70% of you are projecting to pay more in taxes, 30% about the same, and nobody believes they will pay less in taxes this year, which I agree. It's, you know, last year was not the best year, and this year is definitely a solid year for most. All right, so on to business tax planning. So the first thing you should do is you should review your retirement plan design. Make sure that you're maximizing the contribution for the owners. Andy had a great presentation on this a couple weeks back. If you have any additional questions or want more information, please refer to that. Another thing you can do is make sure you're reimbursing the owners for professional business expenses that are paid personally. You can set up an accountable plan, make sure you're getting reimbursed for your cell phone, dues, licenses, mileage relating to continuing education, or other travel business related expenses. You can look at utilizing Section 179 deduction or bonus depreciation on new assets. If you know that you have some equipment needs for early next year, you can look into putting them into place and put them into service in the current year to get the deduction. You can look at restocking on supplies. Just be careful with the inventory because you cannot get the deduction. Consider a high deductible health plan. This is where you'd have a minimum $2,800 out of pocket, but a maximum $14,000. You can put up to $7,200 for a family into a health savings account. Yeah, it grows tax-free. It's not a use it or lose it scenario. So you don't have to worry about making sure it's getting used every year. Then you can look at managing your year-end taxable income by utilizing Section 199A qualified business income deduction. Because you are veterinarians, you are subject to the specified service, trade, or business rules. There's phase out. So if your AGI gets above 330,000, you'll start the phase out. If it gets above 300 or 430,000, then you're going to be out of that phase out, and you're not going to be able to take advantage of the qualified business income deduction, which could be up to 20% of your pass-through income. You can you can consider electing X corporation status. You can save quite a bit on payroll taxes. You can save up to 15.3% if you're going up to $142,800, which is the Social Security maximum. And then if you get above that number, you're still looking at saving 2.9% in payroll taxes. You can consider employing your spouse, have them be a part of the retirement plan, make retirement contributions, and you can defer income into retirement. Another thing you can do is you can employ your child where they can earn up to $12,000 without having to file a tax return or pay taxes. make sure that they're actually working, doing something good for the practice. And then you'll have the opportunity to set up a Roth IRA contribution on that earned income. And that grows tax-free and there's no required minimum distributions, and they could have a great start on retirement. Something we've seen across all professions is employee retention issues. If you have that extra cash, consider year-end bonuses, perks, gifts, things to keep that employee satisfaction high. Another thing we got to look at is separating your deductible travel, which is 100% deductible. And then we have meals now that are 50% and 100% deductible. 100% deductible meals would be your office outings, Christmas parties, that type of stuff. And now for 21 and 22, any restaurant meals that you have, including takeout, is available for that 100% deduction, which was previously 50%. Just keep in mind that entertainment is not deductible federally. Another great tax planning idea is the Wisconsin pass-through entity level deduction. It's an election that is made on an annual basis. You pay a corporate tax based on the pass-through income that you have. That tax is deductible federally, and essentially the federal tax savings that you have will outweigh the Wisconsin corporate taxes that you are paying. Lastly, you can defer income here by holding off on putting checks or cash into the bank until January, or you can accelerate expenses by paying rent for January early if you need to. Next, we'll talk about the individual tax planning. Many of you might have noticed that you took the standard deduction over the last year or two, and that is because your state taxes and property taxes are being limited to that $10,000. And so a couple ideas on getting back to itemizing is feasibly using appreciated stock as a charitable contribution. You get the date of value when you donate it, not your cost basis. Another thing you can do is consider is donor advised fund, where you're able to bunch 3 to 5 years of charitable contributions into 1 year, get that deduction in the first year, but then you're actually able to make those charitable contributions over that 3 to 5 year period. Remember to set up a retirement plans for you and your spouse's other businesses. Look into contributing to a non-deductible IRA, and look into the backdoor Roth IRA conversion. This is where you could put money into the IRA after tax, and then you can immediately switch it over to a Roth IRA, which can, once again, it grows tax-free. There's no required minimum distributions. And it's a great way for a retirement vehicle to put extra money away. You can use Advest contributions for savings for education. You can not only do it for your kids, but you can do it for yourself. This is $3,200 plus subtract, or you're able to put in more than $3,200, as much as you want, but you can get a subtraction on your Wisconsin return of $3,200 plus per person per year. We've had people where the adults will set up the education plans, and then they'll transfer the money into the child's plan when they need to use it. This year, the child tax credit and dependent care credit is increased. Some people might have received the $500 monthly check from the IRS. This relates to the child tax credit, where you're getting between $3,600 to $3,000 on children 17 and under, and then $500 if they're over 17. The dependent care credit increased dramatically. You could get up to a 50% credit on up to $16,000 in qualified expenses, which would lead to an $8,000 credit per person. The maximum is $16,000, and the AGI limitations kick in at about $125,000. You can also consider Roth IRA conversions. You might have a couple of small IRAs sitting out there doing nothing, but these IRAs might not allow you to make Roth IRA or backdoor Roth IRA contributions. So it'd be a good idea to convert these, which would enable you to make these backdoor Roth contributions in the future years. Now let's take it back to Andy to finalize this.
All right, thank you, Joel. You know, with so much information presented, I wanted to narrow it down. And before I give you your final takeaways, I've been saying this a lot, and it may not apply to you anymore because you've already done it. But again, just in case you haven't heard it yet, you know, interest rates are still at near or historically low levels. Okay. And so if you haven't already, look at all your debt: personal, business, real estate, practice acquisition, line of credit, equipment loan, whatever it is. There are banks lined up ready to talk to you, ready to give you the best rate possible, ready to fight for your business. Okay. So if you've already done it, check, great job. If you haven't, it can save you tens of thousands of dollars long into the future at a fixed rate. So make sure you're looking at your debt if you haven't already. All right. So where do you go from here? It's very important to me. Talk to your advisor. If you're a client, we're going to have these conversations between now and the end of the year. Okay. If you're not a client, make sure you are either talking to your advisor, or like I said, if it's time for a new advisor or you want another opinion, we'd love the chance to talk to you. The next one, I know I keep hammering at home, but it's my number one priority for 2021 and 2022 for vet practices. It's look at your retirement plan. Maybe the plan worked for the first 20 years of your career, or when you started the practice, you just didn't have the cash. Look at it. That's probably the best way to save on taxes, make your employees more loyal, potentially recruit them. And also, just the earlier you start, the sooner you can retire and move on to, you know, the next chapter in your career or your life. So look at your retirement plan. Discuss the timing of your depreciation expense, you know, especially if you've made significant expansion or build out or purchased, invested in equipment. Let's consider that. Let's look at all the factors to make sure you're getting the best bang for buck as far as tax savings on that. Make sure your business expenses are paid or reimbursed, you know, by the business. I still run into a lot of newer clients who haven't had great advice, who, you know, pay some of the business related expenses with a personal credit card for various reasons, but those expenses never get funneled back through the business, and they're legitimate business expenses. So make sure that anything that you can tie back to the business is paid by the business, especially now that they're not proposing to eliminate the backdoor Roth. I think it's really important to see, in conjunction with your retirement plan, do I qualify? Okay. Frankly, there are people that do it that technically aren't doing it correctly. So it's not for everybody. It depends on whether you already have a traditional IRA. But right now, again, because you're flush with cash, find out if you and your spouse qualify for what we call the backdoor Roth. And then last but not least, you know, look where you are on the QBI threshold, the qualified business income, because depending where you're at, it's a 20% deduction. It's a big deduction at the business level, and if it passes through to you individually at the individual level. And there's different thresholds. And as veterinarians make more and more money, okay, you're moving potentially up those thresholds, and more tax planning ideas and strategies may apply to bring you down a notch on those thresholds and maximize the related deduction that you can get. Okay. Before I send it back to Lee to wrap up, one final poll question. All right. So based on everything that was presented, very simply put, do you need some tax planning? Or you know what? I think I'm as good a shape as I can be in for 2021. What do we got? All right. I love it. I think we accomplished what we set out to do, and that's really to give you some ideas, make you aware of what's out there, the opportunities, and really send you on to, you know, talk to the professional that you work with. So awesome. Lee, I'll pass it on to you to wrap up. Thank you, everybody.
All right, nice job, you guys. That last poll question tells us that you're right. You did a good job covering all the topics, and now people have some work to do. Hey, real quick, we did have a few questions come in. Andy, I want you to hit quickly on one of them. You talked about you see some practices paying business expenses personally. Can you just talk about sort of the 2 or 3 most common ones you see people doing that with?
You know, I think most commonly, even with recent conversations, these days people don't realize home internet. You know, I think whatever the fair market value is of having Wi-Fi at home, you can clearly need that, you know, as a business professional, as a veterinarian, you know, to connect with your business. So I think a monthly reimbursement of your home internet costs is one I see missed a lot. Cell phone. I see a lot of people that have a cell phone, but they're not running that through the business. Clearly, you know, you can't operate without that. So I think those are probably the 2 that I see missed the most. And just another, give you a best practice is try to, if we all use credit cards now, right? Because we're trying to, wherever we are in life, we want those perks that associate with that. So we pay everything on a credit card and we pay it off at the end of every month. Have a personal card and have a business card, okay? And if everything you can tie back to the business, pay on the business card and then give it to the office manager, the bookkeeper, whoever's doing the books, and have that card paid by the business and the expenses allocated appropriately on the business P&L.
Great. Thank you for hitting on that quickly. Somebody had chatted that in. So as we wrap up here, I just want to let everyone know that SVA has created a resource page, which is svaccountants.com/vet, where the recording of this webinar will be located, as well as e-guides and past webinars, upcoming events, other resources that we have specific to the veterinary industry. Our next veterinary webinar will be on December 14th, and the topic will be 8 ways to improve profitability and drive growth in your veterinary practice. I want to thank Joel and Andy for that great presentation. We were afraid we wouldn't have a lot of time for Q&A. We were right, but hopefully you all had some key takeaways. And I just want to remind you that for those of you who do have additional questions, the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA contact. And if you're not currently an SVA client, contact me so I can get you the help or the answers that you need. Thank you again for joining us today. Have a great rest of your day. We hope to see you at our next webinar on December 14th. Bye-bye.